investment managers. Long ago, Manish had told us that we fund managers have ice water in our veins. We have nerves of steel. And I guess all of those need to be pulled into question right now with the markets doing what they are doing. Manish, is it easy to have those nerves of steel currently, or are you wondering where the next hit to the portfolios could come in? Because it seems to be coming in every second day.
So we are used to these sort of situations, Niraj. So this is not the first time that we have seen these sort of drags. You have seen 2008 global financial crisis, Asian crisis, COVID, and now this is the recent one. So nothing too extraordinary or alarming, given the drawdowns that you are seeing. But yeah, it is unnerving. That's to say the least. I think the situation looks like to be stabilizing. Of course, it's very fragile, and new developments emanate every day after we close. So how do we look at this situation? I think 24,000 is a pivot on Nifty 50. And why I say this, because over long periods of time, this 18 price earnings multiple have stayed. Now you could argue that given that oil is at 110, and this could have a damaging impact on the earnings. So even if we build in, let's say, some damage on earnings, and we look only at FY27 numbers, it's no point looking at FY28 right now. Before all this started, everybody was working with 1250. Now, let's say you take some depreciation, let's say a 50% margin compression going into the first quarter FY27, and inflation is going to move up, costs of capital is going to become dearer. All of that built in, you build in another 5% depreciation in earnings for FY27. Even then, we are traversing on a deviation away from that 24,000 pivot. Now, how far can this go on the downside? It depends on what sort of a Six Sigma event that we are building in. Nobody built in damage to energy infrastructure, which could impact global prices, but it's happening. So 1 sigma deviation away from what is the normalized situation, you could be looking at, let's say, 22,000. And that is what we defended even during Operation Sindoor. So we are very close to those levels. So that's how I would read the situations. And, we always think in these sort of extraordinary situations that the world is going to come to an end. World never comes to an end. Market always reverts to mean. So some could say that the glass is half full. Some would say that the glass is half empty. That is how opportunities emerge. So I'm in the camp who is an opportunist and an optimist. And I think these sort of times one should, if somebody has dry powder, should look into deploy more. If somebody doesn't have dry powder or fully invested, one should keep the faith and, hope for better times to come.
Yeah. There are several sayings about hope and dunya kayam, etc., etc. Manish, but having said that, let's talk about earnings impact, right? You mentioned energy infrastructure. I'm just wondering, because this kind of an incident hasn't taken place in this century, is there an underestimation of the extent of the damage and impact? Because a lot of people seem to think, Manish, that once this settles, and the dust will eventually settle, that things will bounce back very quickly. Oil will fall from those heady levels that it currently is at, and it's heading towards that $120 per barrel mark, and that supplies will be adequate. But let's face it, infrastructure is getting damaged, and some are estimating that it'll take years, not months, to get things back in line. So are people underestimating the extent of the impact?
Look, we have seen this $140 crude in the past also. Infrastructure getting damaged will take, let's say, 1 to 2 years to build. There are alternate supplies. You have Russia, you have the US, who can fill in the gaps because there's ample reserves of energy and it just needs to be tapped. If the Middle East is one source and it gets damaged, of course, supplies are going to move to other parts of the world and they could benefit more than what the damage has been from the Middle East. So supply chains will get disrupted, working capitals will get elongated, but I think it's not going to be like that. The world is not going to have energy at all. In our country also, we might pivot to renewables as an increased focus. Government may incentivize more. So sources of energy might change, supply chains of energy might change, but I think that is the impact that one needs to see. And it's not that, we haven't seen these sort of situations in the past. We have seen it. And near-term damage to earnings is getting priced in as we speak.
No, so Manish, what is then the conclusion of it? Because I think you are one of the relatively optimistic voices that we've heard since this morning, saying that we have seen bad times like this. By bad times, I'm assuming you're talking about crude at 112. Would you have the conviction to go out and buy right now then?
100%.
Really?
100%. Yeah, absolutely.
What would you buy? What spaces would you look at right now? When you're seeing
there's collateral damage across the sectors.
Yeah.
Tamanna, there's collateral damage across the sectors, but relatively speaking, anything to do with healthcare is immune. Whether it is health insurance, whether it is hospitals, whether it is pharma, these are immune. You go to talk about metals or critical minerals, this AI infra build is here upon us, and sooner or later when this whole war situation diminishes, again you'll have that renewed theme of AI getting built, and in that the critical mineral space is likely to be much in focus. So that is another space where there's opportunity. We have seen enough damage in the technology space. Now these companies are trading at 5% free cash flow yields. So whether there's an opportunity, of course there's an opportunity. You can't have earnings yield or, free cash flow yields of 5-6% and see further damage. Unlikely. These are some of the spaces which look pretty much there. Of course, now when we are looking at, let's say, elongation of working capital cycles, of course, near term or just in time inventory is no longer going to be in vogue. You'll have enough days of inventory that will be required, and all of that means better opportunity. Working capital facilities required will be good for credit growth in the system. So again, banks and financial services will come into focus.
Since you talked since you talked about banks, I know you might not talk specifically about HDFC banks, but are private banks something that you would look at, or public sector banks?
Private sector banks as well as public sector banks. Of course, one thing which I must highlight out here, that the market share loss in the loan book of public sector banks is not falling anymore. So market share of public sector banks, which post-COVID was declining, is now stabilized at 60%. So PSU banks are no longer losing market share to private sector banks. Of course, deposit market share, the private sector banks still have an edge. The deposit accretion to private sector banks is still. But when we talk about the LDRs, the credit to deposit ratio, we are somewhat more, favorably placed as far as PSU banks are concerned vis-a-vis the private sector banks, because there's a scramble for deposits in the system, and because of ATC deduction not being there, savings deposits is a problem. So all in all, I think it's a pick and choose. Valuations of PSU banks are quite lucrative, and valuations of private sector banks are also correcting. So anything closer to fair values on the price to book basis, given vis-a-vis the growth, those are a buy, both in the private sector and PSU banks.
Manish, presumed in your gumption to buy currently would be a hypothesis of peak oil prices currently, that they will not substantially stay longer from here on, right? I presume. And
so Niraj, the way to look at it is how much is going to be the damage to your growth.
No,
right?
so okay. Sorry, but my question was more specific for OMCs. So what I was trying to think was that if that is your hypothesis, that oil prices will not necessarily stay longer for longer, there's been severe price damage in oil marketing companies already. Do you reckon they give you an optionality currently, or that sector is out of the window?
100% is an optionality, because you value these sectors on price to book, never on price to earnings. And anything below one-time price to book is a margin of safety. Particularly in the energy space, when we are talking about next 5 years, power and energy is going to be in focus. India is going to require a lot of energy, given that we have to build the AI setup. In that, so-called commoditized sectors will be bid after. And let's say near-term price escalation is not happening due to crude oil prices. That creates a cushion as far as margin of safety in some of these power and energy and ONCs. It's all proxy to energy, right? So, it creates margin of safety. It's a buy, according to me.
Okay, some conviction there, and yes, things will turn. Question is when and how long can you as an investor hold out? Manish Sonthalia, thank you so much for speaking with us this morning. And, we're talking about now relief measures which need to come in for